All right, time to look at some more loan scenarios. We are going to look at the same loan scenario we looked at in the last video. We're just going to build on top of that now. So in our last video, we looked at that scenario of a 45-year-old individual paying into the policy for 5 years, $100K per year, $500,000 total, that $300,000 loan coming out. What we're going to look at in this video, though, is the same thing. We'll start off with the same example we looked at in the last video, what it looks like when he pays the loan back in full. But then, what's it look like if he doesn't pay anything in full? Pretend this is you. What's it look like if you think you could pay it in full, but you end up only paying the interest only? As we see different options there up front, this has really helped people make an informed decision before even starting a policy with respect to how they want to use it. A lot of times people say, all right, I'm still going to maximize the cash value. I like the flexibility feature, like how to optimize the value. That's fun. But when I use it, I thought that I would never have to pay back loans. But now after seeing the numbers, I see if I take a heavy loan against the policy and never pay it back, if I've overloaned it to a degree, meaning I've borrowed out a dollar amount where the total loan interest actually exceeds the dividends and interest I'm being paid from the company, that could end up hurting me. So it is so beneficial to see that up front. So let's get on into it. We will start off with the same example we looked at in the last video. I don't want to spend a ton of time on this because we did cover it in the last video. The main thing to hit on here is when we look at it, what do you notice? On the left, we've got an example. Up top, it says growth. I pay money in, I let it sit and grow. This shows me what the policy looks like if I do not touch it. Okay, it looks great. Breaks even year 5. Death benefit of $1.55 million. When you take the $300,000 loan in year 6, what happens to your policy? I see my cash value does drop. The cash value, think of it as your equity. That's the amount you actually have access to. In the same year 6, if you don't touch it, would have been worth $522. So why did it drop by more than $500,000? Sometimes that question comes up and I did not hit on that in the last video actually. So the reason why is I took the $300,000 loan. That lowers my available equity. Also, what's happening in this example is we didn't pay anything in the first year. So if you were to deduct the loan interest dollar amount there as well, that's what my cash value actually dropped to. $316,950. The loan plus the loan interest in this particular example. But that's why it dropped by more than the $300,000 because it is accounting for the loan interest as well. But anyway, in this example, when you do take the $300,000 loan, there's the cash value drop. Look at the death benefit, dollar for dollar drop. So the fact that the death benefit is held as collateral and I have a cost to borrow, there's the loan interest. There's the loan interest payment. So it assumes you're paying it to the insurance company. For those reasons, death benefit collateralized and the loan interest being paid to the company, that is really how the insurance company continues to pay you, the policyholder, dividends and interest on your entire cash value as if you never touched it in the first place. And you can see that here because when we repay it, what do we notice? So in this example, this is at year 17, loans paid off in full. There's your cash value and death benefit. Cash value is $851. Death benefits restored to the $1.55 million. How about over here? Cash value is $851. Death benefit $1.55 million. They're exactly the same. And this would be the same result with this policy if I made no payments, let's say for 9 years, and then in the 10th year, I just write a check for the full loan amount and pay it off in full. I would see everything fully restored to exactly what it would have been as if I never touched it in the first place. This is a non-direct recognition policy, just to add that technical detail in. So this is all well and good because I pay it back over time. What if life happens though? Let's look at the no repayment scenario. This is the one that is so important to see. So we've got the exact same scenario here. Growth, $100,000 per year for 5 years. There's my break-even point, year 5. This policy, by the way, can be improved. We just set it up with a level death benefit to demonstrate how loans work here. When I say be improved, we can beef the cash value up more. But here, there's my break-even of year 5. let the cash value sit and grow. Over here, loan and no payments. Interest rate at 5.65%. We kicked that up. We made it higher than what it actually is right now, just in the event interest rates continue to go up for a little bit. It makes it a bit more conservative. There's my $300,000 loan. What happened in year 6 compared to the last example we just looked at? Everything's the same. There's my 205 in cash value. There's my $1.25 million in death benefit. So if I die in year 6, say the day after I take that $300,000 loan, that's the death benefit that will be paid out to my beneficiaries. Now, what do we see beginning year 7? We don't have any purple columns here. We're not paying anything in, not doing that on either example. But annual loan, we're not taking any more loans. Look at your loan balance. What's happening here? It's compounding over time. So annual loan interest accrues how over the course of 1 year? That's simple interest. However, if the loan interest is not paid on my anniversary date, what happens? The policy takes a loan against itself to cover the loan interest. So when it takes that loan, it's added to the balance. This is why that loan balance is increasing here. So there's the loan interest. There's the loan balance. What happens with my policy value? So in this particular example, you paid in $500,000, you borrowed out $300,000, and you don't pay a penny back. So how some people look at this to say, okay, by the time I'm 60, I paid in $500,000, I took a $300,000 loan, so I view it as I paid in $200,000 total to the policy. Like that's the net dollar amount I've paid in, and the loan interest is riding over time. And I've got $250,000 plus in cash value. Okay, so I've got a little bit of a gain. Great. Some people do look at it that way, which is okay, but I kind of emphasize that okay for a reason. What happens when I scroll down? Cash value continues to increase, but what happens down here? Now I'm getting close to mortality or to death here, but what do you notice about the value? Cash value begins to decline. Why is that? Well, that loan balance is getting large here. And whatever you see in cash value and death benefit, what I want to add about these are the net dollar figures pulled directly from the life insurance illustration in the software. But this is the net cash value that I still have access to, and the net death benefit that is paid out to my beneficiary after the loan's accounted for. For example, if I receive an inheritance, let's say at age 90, for $2.5, almost $2.6 million, I write a check to the insurance company to pay that loan off. What will happen is pre-loan, I was $314,000 in cash value, $661 in death benefit. I write a check and pay it off. My cash value will be restored to $3 million and change, and my death benefit, $3.22 million, which will then be paid income tax-free to my beneficiaries. But point there is if it's paid, I see it restored. However, here, look at that loan interest. It's compounding, and why my cash value is going down here for a period of time is because the loan interest on the policy is exceeding the gain on the policy. And that even accounts for the fact that I'm still earning interest on my entire cash value as if I never touched it. The loan interest where we kicked up the rate here is outpacing the earnings rate, which is important to look at just to keep things conservative. Now, he only initially took out $300,000 where he paid in $500K. Where people can fall into a trap here is if we were to go back up to year 6 and model $400,000, meaning a loan of $400,000, and ran this same scenario, what would happen is if that cash value gets too low and eventually hits 0, or we get to a point in time where the policy says we can't cover, the policy says our cash value, it cannot cover the loan interest that's still due. What'll happen is the policy will call for more money, and this money is out of pocket from you, the policyholder. That if the policy is still payable, say it's a whole life 100 contract and we have not done a reduced paid up, A, I'll have to pay premium, or B, I will have to pay the loan interest or some of the loan interest. If I don't and the policy lapses, it can trigger a large taxable event. Now, tax advice is given in this video. I would check out our whole life taxes video that just provides some examples of taxable events with whole life insurance policies with non-MEX, that is. So it's very, very important to be aware of that. But in this case, you don't have to worry about anything. However, this is something we do monitor closely. When a taxable event occurs as a result of a large loan balance, it doesn't happen that much with whole life. It has happened with universal life insurance policies, but really when it happens is when the policy is neglected. I'm a policyholder. I took a lot of money out because I was told it was tax-free and I wouldn't have to pay it back. The agent is no longer in the business or something happened to him. He's no longer around. And then several years go by and I receive a notice from the insurance company that you have to pay this loan interest, otherwise your policy will lapse, which may trigger a taxable event. Or someone else tells me that, like, what? I was not told about this. How do I prevent this from occurring? So neglect really has to occur for a big taxable event to occur, which in this case, it wouldn't even happen. If I loaned out more and didn't pay it back, that's where it could happen. Let us know if you have questions on that though, as we can always provide information, can talk you through it, or provide videos that provide education on that. So that's no repayments. And then let's see what it looks like if I do pay the loan interest. Same scenario here. This one's fun. We kept the loan interest rate at 5.65%. There's my growth scenario. This one will be fun just to track everything. Here's your $300K loan. Everything's the same in year 6. And then the loan interest comes due, and I pay the loan interest each year. The time passes by. Let's look at age 75. This will be pretty cool. What's your loan balance here? Loan balance at 75, $300,000. Because you have paid the loan interest every single year that it's been due in this particular example. Your cash value is 1,265, so over $1.25 million, and your death benefit is $1.7 million. Guess what happens if you pay off the loan? It's restored to these values right here. And you'll see when you look at that, how much less is the death benefit right now? When you look at the growth example with no loans compared to the loan scenario. They're identical. Well, identical minus 300K, I should say. If I paid it back, then it would be identical. I see the difference in cash value as well. It's pretty interesting when I look at that. So what I do like to do here, because this scenario does work if I keep paying the loan interest, just for the sake of showing someone how much they're actually paying out of pocket, what I might run here, let me show you real quick, is something like this, is just tally up the total loan interest payments. So here's the total dollar amount I paid in loan interest to the life insurance company over time. So what some engineers like to do, or people that really like to break down the numbers and see how much did I pay in compared to how much did I receive from the insurance company. First, we would tally up the actual payments. Is I can see how much did I pay into the policy? $500,000 total, but I'm also paying loan interest to the insurance company each year. So here's my total out of pocket. But then I got to do one more thing. I'm going to simplify this, I promise. All right, cool. Let me just paste that as plain text. Get rid of the other stuff. Bold this. All right, so this shows just total input, and it accounts for premium and PUA payments, loan interest payments, and it also accounts for the fact that I pulled $300,000 and I actually used that. So I took that out of the policy via a loan. So now I can see how much did I pay in net, accounting for my loan interest each year. And with all of my payments going in, do I still have more money in cash value? Meaning, do I have some type of gain? And the answer is yes in this example. It typically will be yes, especially if I'm paying the loan interest. But point is, it's always good to look at different scenarios. And depending on how deep you want to go, meaning if you want to see numbers like what we just looked at there, breaking down, okay, can I see the loan interest, factor in the loans I pulled out? We can do that. You might be able to do it on your own. I do like when people kind of make things easy for me. So we do try and do that for you. If you ever have any tips on that, do let us know, because I am all about trying to make the customer experience as easy as possible, just speaking generally when it comes to business. In any event, I hope that you enjoyed this video. We will see you in the next video, which we will address the questions that a lot of advisors and higher income earners often bring up, which is analyzing the net growth rate, the net growth dollar amount, and comparing that to the actual interest I paid to the company or cost to borrow. See you in the next video. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.